Evergreen funds, open-ended private investment vehicles without a fixed termination date, are gaining traction across private equity, credit, and real estate. Their appeal is clear. They offer long-term capital compounding, flexible investor entry and exit, and operational continuity. But with that flexibility comes a unique set of operational and valuation challenges that fund managers and service providers must navigate carefully. What makes evergreen funds different? Unlike closed-end funds, evergreen structures allow for ongoing capital inflows and redemptions. This means no fixed life. The fund can operate indefinitely, subject to investor appetite and performance. Rolling subscriptions and redemptions. Investors can enter or exit the fund at periodic intervals, often quarterly or semi-annually. NAV-based pricing. Units are typically issued and redeemed at net asset value, NAV, requiring frequent and defensible valuation processes. These features make evergreen funds attractive to long-term investors, like family offices, insurance companies, and sovereign wealth funds, but they also introduce complexity in areas like liquidity management, fee calculation, and investor fairness. Valuation, the core operational challenge. The most critical operational hurdle in evergreen funds is valuation frequency and rigor. Because investors can enter and exit based on NAV, the fund must produce timely, accurate, and supportable valuations, often quarterly or even monthly. Key challenges include illiquid assets. Private investments don't trade on exchanges, so valuation relies on models, comparables, and manager judgment. Fairness across vintages. New investors shouldn't dilute existing ones, and exiting investors shouldn't receive more than their fair share. Audit and governance. Frequent valuations must stand up to auditor scrutiny and align with the fund's valuation policy. Some managers address this by using third-party valuation agents or implementing tiered valuation policies, e.g., full external valuation annually, internal updates quarterly. Others build internal valuation committees with cross-functional representation from finance, investment, and risk teams, liquidity management, and redemption gates. Because evergreen funds offer periodic liquidity, managers must balance investor redemptions with the illiquidity of underlying assets. Common tools include redemption gates, capping redemptions at a percentage of NAV per period. Lockup periods, restricting redemptions for a set time after investment. Side pockets, segregating illiquid or hard-to-value assets to avoid distorting NAV. These mechanisms help protect remaining investors and preserve the fund's long-term strategy, but they must be clearly disclosed and consistently applied. Fee structures and investor alignment. Evergreen funds often use asset-based fees rather than traditional private equity-style carry. Some managers introduce performance hurdles or fulcrum fees to better align incentives. Fee transparency and consistency are critical, especially when investors enter at different times and valuations. Bottom line, evergreen funds offer long-term flexibility but demand operational discipline. Valuation, liquidity, and investor fairness must be front and center in fund design and administration. As these vehicles grow in popularity, fund managers and service providers alike will need to evolve their infrastructure and increasingly their use of technology to meet the challenge.